So if you're like most people, you probably want to pay less in taxes. But the question is, how do you actually go about doing that?
Well, you know what my feelings are about this. I don't even pay taxes.
Yeah, that's easy when you have no income.
Hi.
Hey.
Hi.
Okay, well, I guess you could quit your job. And if you did that, you'd probably pay less in taxes. I guess this video is done, right?
I can get a job tomorrow in the Air Force. I quit.
Oh, somebody help him out, for God's sake.
You gotta use your lower back.
Okay. No. I'm not encouraging you to quit your job. But what if I did tell you that the amount of tax you pay is completely under your control? See, to a certain extent, you can manage and reduce the taxable income you will have when you get to retirement. And if you want to find out how to do this, you're going to want to keep watching this video. So if you don't know who I am, my name is Jason Kennedy. I'm the founder and advisor for the Kennedy Financial Group. And for almost 15 years, we've been working with families to help them to preserve, save, and grow their money in a tax advantage way so that they can have the cash flow in retirement that they need. Now, to set the tone for this discussion about taxes, I want to share a quote. Here's what it says. It says, "Anyone may so arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose the pattern which best pays the treasury." And get this, there is not even a patriotic duty to increase one's taxes. Now, this ruling was the result of a decision rendered by Judge Learned Hand. And what he made really clear in this particular ruling was that each individual can decide for themselves, based on the choices they make, how much they pay in taxes. And this makes tax planning an essential part of any retirement plan. So in this video, what we're going to seek to accomplish is we're going to explain the progressive nature of taxes. We'll talk about the different accounts you can put your money into to allow that money to grow tax-free. And then we'll give you just a brief overview of how they each work, what the IRS limits for contributions are, and hopefully that'll get you started in this process of trying to manage taxes throughout your working life and into retirement. So let's start by answering the question, how is income taxed? Really, in order to understand how our retirement income is taxed, we need to understand how income is taxed today. Now, we live in a marginal tax system. This means that the tax rate for an individual increases as their income rises. If you notice on the screen, you can see that our tax rates are marginal. It's based on how much income we have. Now, if you just use this merit tax bracket as seen here in this example, we can kind of see how this works. So you probably noticed the income is going up. The more income a person has, the more taxes they're going to have. Now, ignoring the standard deduction or any other deductions a person may have, that first $20,500 worth of income is taxed at 10%. Everything between $20,000 and $83,000 is taxed at 12%. Everything in between $83,000 and $178,000 is taxed at 22%. And so on. So if a married couple made $200,000 a year, they would pay 10% on the first 20,000, 12% on the next 60,000, 22% on the 94,000, and 24% on the next 22,000. Now, why are all of these numbers important? Well, it's because withdrawals from your untaxed retirement accounts will push you into potentially higher tax brackets and require you to pay more money in tax. And that's important to understand right now. The second issue is that your income could cause your Social Security to be taxed. Now, as an example of this, the 2022 tax year, 15% of all your Social Security benefits are tax-free. Now, the remaining 85% of the Social Security you get each month is also tax-free as long as your provisional income stays below a certain threshold. Once you begin to make over a certain amount of money in retirement, now your Social Security becomes taxable, even though you might have viewed it as a tax when it came out of your check. So provisional income works this way. If your income is in between 25,000 and 32,000 as a single person, then 50% of your Social Security income is taxable. If your income is above 34,000, then 85% of your Social Security is taxable. Now, it's not much different as a married couple. If your provisional income is between 32 and 44,000 as a married couple, then 50% of your Social Security will be taxable. And if you make more than $44,000 a year, then 85% of your Social Security is taxable. So we really could sum this up by saying that unless you plan to significantly reduce your income in retirement, you could cause your Social Security to be taxable if you do not plan for taxes before you get to retirement. Now, as a side note, no inflation adjustments have been made to those limits. And as a result, most people who receive Social Security benefits and have other sources of income end up paying some type of tax on their Social Security benefits.